Good afternoon once again. Thank you very much for being here with us. Ashish ji, this week's been pretty decent for the markets after many days and weeks of pain. In fact, perhaps the best week in 4 years. But this is not a question with a market, a guru kind of approach in mind. The rise of the equity cult in India is now undeniable. And I don't know how many people here in the audience know that the National Stock Exchange is present nearly in every pin code of this country. Now it could be because they want to be there, but it's also obviously on account of the fact that they have to service a market where almost everyone is doing something in the Indian equity market. What explains this? Is this a fundamental shift in approach towards markets, towards equity investing in India?
Thank you, Siddharth, and thank you for calling me. In some ways, it can be answered in many ways, but currently, as you rightly said, we have more than 19,300 or 400 pin codes in India, and we are not there in 28 pin codes. And most of those pin codes are now airports, where you can't be staying full day normally, and so I can't do KYC for you. So effectively, it's there. And why this has happened? It's kind of interesting because I have been there for last 34 years in this business of running markets. When I joined in 91, 92, there were around 1 million people investing in stock markets. Unique individuals, 10 lakh. Today, there are 11 crore unique investors. That is literally 110 times more people. And that is something which I have seen with my own eyes. Why do people invest in stocks? And what is investment in stock? There is a theory in economics which says that low per capita income countries do not have good capital markets, good equities market. Why? Because poor people cannot save. And if they save, they don't trust even their brothers. How will a person sitting in Srinagar or Dibrugarh or Jorhat will put her hard saved, not hard earned, but hard saved, 1,000 rupees or 500 rupees into somebody running a company in Salem, in Tamil Nadu, which she is never going to visit. But she has that complete confidence that that entrepreneur who she is putting her money in has made her a partner. And he is going to work completely, fully for her. So whatever business profits come, that small little fraction of that profit which she owns as a share will come back to her. It's such a great leap of faith on her behalf to be investing that 500 rupees or 1,000 rupees, sitting away 2,000 kilometers, not knowing the promoters, not knowing entrepreneurs. And for me, that is what I call the trust. Trust of whom? Trust of ordinary Indians, that poor Indians, into other poor entrepreneurs. Of course, I can see some rich entrepreneurs also sitting here, but it's for me in 78 years of independence, right? 1947 and 2025. 78 years of independence. What have we earned as a nation? For me, we have earned trust by our entrepreneurs of our people. I think that is the statement that is coming out. And 11 crore, it may look like a very small fraction of India's population. It is not, because 11 crore people is actually 8.5 crore households. India has give and take 35 crore households. So almost 1/4, between 22 to 23% of all households in India now directly invest, either through mutual funds or into stocks. Sort of investing into trust markets. Prices may go up, prices may go down. So that is one explanation, that our entrepreneurs have generated that trust. Of course, our parliament needs to be applauded, our judiciary, our regulators, our exchanges, but the relationship of trust is between the entrepreneur and the investor, right? And that's for me a great statement. It's where in what we call equity cult. Today, our 22% of people investing is larger in percentage compared to even France or Germany or other developed markets. And that is telling you that Indians are more trusting of their entrepreneurs than those developed, so-called developed countries. And that is, I think, what is the statement that comes out.
It's an important point about trust and entrepreneurship, and we could separately debate about whether the system in India, especially the regulatory and bureaucratic system, trusts our entrepreneurs. But I'll leave that for later. How much of a role has technology, the ease of access, digitalization had in the rise of the equity cult, from an era where you had to fill forms to now being able to do it virtually in seconds on multiple apps? How much has technology played a role? And you yourself are a technologist, therefore that question to you.
For me, the technology changes everything. Technology is the only change that happens in the world. The rest of the world actually dances and surrounds it. And all the changes happen are primarily due to and only due to technology. There is no other change that happens in the human societies. And the stock markets in India are like primordial reason of bringing information technology into India. We had billionaires happening after 98, 2000 and all in Y2K world. Now we call it VUCA, but basically 92, 93 when NSE was conceptualized, there were not too many computers in India. Telephone lines used to take 5 years to come to your house, and if you have to make it work, you have to pay a lot of bribe to the bridesman. You might recall the linesmen were the largest dowry seekers in those days, right? And so in those days, the policymakers visualized an exchange which would be completely automated, screen-based. There was no screen-based trading in the world. I mean, NASDAQ is considered screen-based those days, but it was actually screen where you get the quotes, and then if you had to trade, you had to actually call people on the other side who had placed the quote. So there was no screen-based order matching system, but our visionaries of policymakers, they decide that you will set up an automated exchange, and we were actually, when I was part of implementing that, and we said, how will we implement when we don't even have telephone lines? And that's where we decided to move on satellite, because satellites were there, we were not using. And that's how a completely in-your-face use of IT happened with setting up of NSE in 1994. Anywhere in India, you could get a response time in less than 2 seconds. And that was the information technology that slowly seeped into India. It was the first public digital infrastructure of India. It was the first fintech of India. It's still the largest fintech of India. But more importantly, it was also the mother of IT. Of course, later on, billionaires started writing books and they became wise people, because billions, when you get, you become wise. But otherwise, it happened, it started with NSE, right? And for me, on the other side, the stock markets actually brought that transparency which was lacking on floor, because floor could handle only 1,000 people at a time, maximum. And this allowed millions of people to see it on screens first and then on their mobile. And I think I recall vividly in 2014 when Mr. Modi became Prime Minister, India had 16 million, that is 1.6 crore investors. When COVID started, we had around 25 million, that is 2.5 crore investors. And then in last 5 years, now we have 11 crore investors, almost 4 times before COVID. Why it happened is because of variety of reasons, but marginal cost of servicing an investor has now become a zero. Otherwise, you have to go to, say, Ladakh and attract investors. You have to set up a branch, which was true with banks also. And that's why banks could not reach, right? That's how Jan Dhan Aadhaar mobile, through mobile, reached out. And then when the COVID happened, the physical KYC was removed by SEBI, saying that now that you can't reach people's houses, go personally to check their incomes and other things, you can do KYC on video. So video KYC is what allowed all our brokers to move out into the hinterland and sort of get people to invest. Of course, returns on the stock markets were much higher than what you would get on the fixed deposits, and that's where also people came in. But there are many, many reasons, but one is the cost of new investor coming down from anywhere in the world, I mean anywhere in the country, came down close to zero, and the video KYC allowed to do it much faster, and that's where we could gather all those investors. And today I have 11 crore unique investors, but literally 21.5 crore accounts. Each, pretty much every investor on an average is getting almost 2 accounts, like everyone is getting 2 SIM cards. So that's how it's happening.
That's a very detailed explanation of how market have evolved, especially in the last 4 to 5 years. Is there a flip side to it, Ashish, in the sense that has this ease of access, ease of selling and purchase also increased risk taking? Has it led to irresponsible behavior or greed, which is fundamental to markets, where a lot of people, without realizing the complexities of the market, the uncertainties with regard to returns, and this whole F&O boom, where a lot of people have been hit. There are several studies which say that very few retail investors actually make money. Is the ease of access actually responsible for that as well?
I think there are many facts, and then there are many analyses, as I think Gaurav Prabhu said, right? And everyone has a view based on where they are looking at the elephant. Because we are all blind men describing elephant wherever we touch. That is how it works. So to give you a perspective, in last 3 years, despite market now going down, Indian investors, that is the retail investors, not the promoters of the companies who own around almost 50% of India's capital markets, the retail investors have made 40 lakh crore rupees after cutting for derivatives losses. There are 11 crore investors. Around today, 25 to 30 lakh investors trade in derivatives once a month, which is around 2% of the investors and some percent of the total population, right? Out of those people who are trading in derivatives at least once, 88% also invest in equities. So it's that probably they are making money in equities. They might be losing money in derivatives. Like you buy health care, right? Health insurance, and you don't fall ill in the year. Is your health insurance a loss for you? Right? And so for me, many questions come in our minds. But effectively, there is a possibility that when things become easy, you overdo it. There is a possibility that the greed is uncontrollable. And that's why the SEBI has also taken steps to ensure that the derivatives are kind of kept out of the reach of small investors who may not be aware of those details and the leverage which plays there, the risks that come out. And those kind of actions which will keep on happening, exchanges will continue to support that, because ultimately their job is to not promote only trading for the sake of it, but channelize the savings of the economy into productive capital. And so there will be actions that will be taken even if small portion of the market is suffering, still the policymakers, because this is like a sacred place, right? If you do something on Dream 11, you will not be asking that question, right? If you do it in crypto, nobody asks this question. But stock markets get asked this question because they are sacred places for wealth creation, for job creation. And that's where many times the participants may feel that the regulators take very tough decisions, but they are for their own good, right? So again, last 30 years, 34 years of my career, I've seen the tougher decisions the regulators have taken in reducing speculation, reducing trading, or increasing margins and other things. They've actually increased comfort of more investors. That's what has brought in more investors back. So effectively, last thing I would say is, when something becomes easy, you do it more. That doesn't mean it is wrong. So when the washing machines came, people thought the ladies will spend less time washing clothes because it will become now easy to wash clothes. You know what happened? They started washing more clothes. And that's what happens when things become easy. But that is not necessarily it is bad, right? Because now you get cleaner houses, at least within the house. Outside you might have more pollution, but inside you have cleaner clothes and houses and stuff like that. That's what finally, there will be more other issues come up and we'll have to keep on solving them as they come.
Do you think the objectives behind the curbs that the regulator, the Stock Exchange Board of India, imposed on derivatives, whether they have achieved the objective that they were meant to?
Broadly, I think everything is a work in process, So today, I think their first measures started getting implemented around October, November. Today we are sitting in March after 6 months. April 1, some more measures are coming. Some more measures are being thought about. So effectively, the volumes in terms of the number of contracts has gone down by 50-60%, but the premium traded also has gone down by 25-30%. And that was the purpose, that they wanted to break the momentum that the sort of perceived sort of options trading was getting. And now I think that momentum has been broken. People are also coming to their senses. And our perspective has been that if you don't know the instrument, don't touch it. So especially for retail investors, derivatives is not the place to be in. They increase the lot size, they increase the margins. Now even intraday margins are going to change. But effectively, similarly, don't believe in tips, don't believe in this discussions that happen on television about stop loss and all. Because if somebody is sitting like me and you ask me saying what will happen to this stock, and I say no, it will go up, do you think I really mean good for you? I am probably selling that, that's why you want me to, I want you to buy, right? So effectively take this as entertainment rather than some sort of an advice when it comes out of the pop circuits or messages or WhatsApp or something.
So since you mentioned television, I want to ask you, what about these so-called influencers on all manner of social media platforms, not regulated, outside the reach of most people? We don't know who they are, what they are up to. Yet they proliferate. So it's interesting you spoke about television, but what about those people? Aren't they also equally responsible?
No, absolutely. It's television is because you're sitting in front of me, but otherwise influencers are equally, and many of them are irresponsible. And what is the difference between a television or an influencer now? Everyone has the same loudspeaker, right? And so people there is a lot of noise and very little signal, right? And at the same time to say that influencers are bad, but we are regulated so we can do it. That is where I also think there has to be some sort of a balance to be maintained, that people who are traditional mediums, do they still have to do it? Or only influencers have to be blamed, and those kind of things.
Is it time for SEBI to sort of relook some of its positions, because April is going to be a very interesting time for our markets, not only because of the other steps that are supposed to come into effect from the 1st of April. On 2nd April, by all reckoning, we will see reciprocal tariffs hit many parts of the world, from the United States, perhaps India as well, although there is a meeting that might help us prevent that. Is it therefore time for SEBI to sort of step back and perhaps pause, given what's happened in the markets, Mr. Chauhan?
Broadly, I think SEBI has, all the measures relating to derivatives have happened. You can see over the last few days some other measures which have slowed down a little. At the same time, what you can predict, that is the reciprocal tariff or anything, is already priced into the stocks. What is unknown? See, there are, I think in Dick Cheney or somebody who said that, there are known knowns and there are known unknowns and there are unknown unknowns. Stock market takes care in everyday pricing, index and other things, the known knowns, and then known unknowns, that is your reciprocal tariff. What sort of jars people is the unknown unknown, that was not even thought, and that is where I think again COVID was mentioned, which was in a way unknown unknown, right? And so that is where, and even Trump's reciprocal tariff, when it was spoken, it was unknown unknown. Now, in last 2 months, it has become known unknown, right?
Absolutely. It's perhaps also been digested to some extent. Exchanges like yours enable access. It allows entrepreneurs to raise capital from the markets. Equally, we have seen in the past few years the age of the IPO. We have had massive IPOs. Many more are in the pipeline. I want to ask you, what is your sense about 2025, the rest of the year? in terms of IPOs? Will the IPO gravy train continue to chug along?
No, the markets have been consistently good over last 2-3 years, and that's where when markets are good, the volumes go up, IPOs come in. Last 6 months, markets have not been good, and so the IPOs have become less in number, but still there is enough and more momentum available. So we see a lot of activity currently also happening in the IPO space. Lot more prospectuses are being planned and filed and other things. It's just that most of them will also wait for the opportune time, which is when the market is on an upswing. And so you might see a little here and there going forward, depending on how the market behaves over the next few months.
Mr. Chauhan, I want you to spend a minute to speak to a general audience regarding this issue that we have seen about loss-making companies hitting the markets, raising a lot of money because investors perhaps have a fear of missing out. And there are people who say that perhaps the system, the regulator, the exchanges need to make investors better aware of the risks. Do you think enough is being done to prevent this FOMO driving people like a herd into certain questionable investments?
There are again several aspects to it. If some of you who are old will recall, there was a controller of capital issues, which used to not only say which company will go to the IPO, but also decide what premium to charge, right? And I think I recall one company called Tata Timken. There were queues outside in 93 or something, or 92, and there were literally millions of applications that came, and then the prices went down after it started because the company didn't do well. So a lot of backlash came saying controller of capital issues doesn't know anything, and we need to have from a prescription-based system to a disclosure-based system. So that's how the rest of the world has gone, that how a bureaucrat sitting there or an exchange official like me who has never made money, that's why he's working in a stock exchange. If I was smart, I would be working in actually as a market guru, right? So whatever I tell, especially on stocks, don't take it seriously. But basically, that's where we went to the disclosure-based system, and now everyone has got an idea that if I invest in an IPO, somehow I have to get a great return. Now, the in the framework of the markets is that some portion of the market companies will go up, some of them will go down. So there is no guarantee that the IPO, when it's listed, it will always list at a premium. At the same time, the other aspect of it, that loss-making companies are coming, they are two what I call independent issues. Even profit-making companies, IPOs may go down because the price was much higher than what the profits can sustain, right? So, like a Mercedes is a good car, but at 100 crore rupees, it may not be a good car. And similarly, a good company may not be good at all prices, so it may go down even if it's a profit-making company. But why loss-making companies come to the markets and why people actually subscribe to them? One is the FOMO part, fear of missing out. But other is actually that some of those loss-making companies may have a great potential future, or at least people perceive that way. So for me, like Amazon.com, that is an American company, Jeff Bezos, it was loss-making for 20 years plus of its listed life, not only unlisted life. And today it's a highly profit-making company. Probably it had some bad quarters also recently, but broadly it's a highly profit-making. So it's not necessary that people look at today's profit or losses and try to invest. There are people who are able to predict future, and sometimes they are wrong. But broadly, awareness about what can go wrong, that there is no license to make money just by putting your orders into IPO. That is what we need to actually make people more aware.
Okay, in the little time that we have left for us, I want to ask you, since we're talking about IPOs, what about NSE's IPOs? We seem to be getting hints that things are moving along. Can you tell us whether there will be a Diwali Dhamaka IPO from the National Stock Exchange?
We have not got the news, but आप जो बोल रहे हो सही है, तो आपके मुंह में घी शक्कर.
Okay, one final quick answer. The battle between FIIs and domestic institutional investors, it's not actually a battle, it's just stock picking. But FIIs have been pulling out a substantial amount of money. recently the trend seems to be slightly tapering off. What's your own sense about it?
Broadly, everyone, either retail investor or foreigners, they are there to make money, right? And if foreigners have ability to also make money out of other markets, which Indian investors don't have, right? So sometimes if they find some opportunities in other markets, they may take back the money from a particular market. But broadly, when interest rates in a main market, which is US, went up over last 1 year, many people borrow money and come into other markets. And that's when the interest rates go up, the cost of investing goes up because every day that meter of borrowing goes up. And so they start taking out the money. And that's what happens many times. Second part is when the Donald Trump, it became slightly clearer by around November, like October, November, that is coming. There was a worry about the US trade deficit, how it will be funded, because the US is now having $35 trillion of debt on its balance sheet as a government, and they're adding probably $3-4 trillion a year. This year probably their average cost of government borrowing is now 3.25% as per whatever I know. Today it's running at 4.5, 4.25 for a 10-year cost. So in a way, people started moving money because the interest rates are higher, and if they're getting in interest in dollars, why would they stay in emerging markets? So all kind of emerging markets started moving out, and that's what we call index-based investments. Nowadays, many fund managers abroad don't invest in specific stocks. They don't have time or even ability. So they invest in, say, MSCI Emerging Market Index, which is India, China, and stuff like that. And so whatever companies are in that index, they put in money in that proportion, and then when they take out money out of China also, India also, and so on and so forth. That's where most of the money went out, was basically largely due to the uncertainty of US's ability to fund its deficits, but also Trump economics and stuff like that. So you have VUCA economics, but I think as Prabhuji said, you could have might as well called it something else.
Absolutely, and we will see how that plays out. Mr. Chauhan, thank you very much for your time here with us today. A round of applause for Ashish Chauhan of the National Stock Exchange.
Thank you so much, Mr. Chauhan. And